Hi everybody, my name is Michael Quinn. I'm one of the directors of the Quinn Group. This month on Quintessential TV, we'll be discussing the taxation implications if you are a non-resident taxpayer in Australia. There are different tax treatments depending on your residency status. To understand your tax situation, you first need to work out if you're an Australian or foreign resident for tax purposes. The Australian Taxation Office uses different standards to the Department of Immigration and Border Protection to determine your residency for tax purposes. For income tax purposes, Australian residents are generally taxed on their worldwide income from all sources. Temporary residents of Australia and foreign residents are generally taxed only on their Australian sourced income, such as employment income from an Australian employer, rental income, and capital gains on Australian assets. The foreign resident tax rates are actually different to the resident tax rates. Non-residents are not entitled to the personal income tax free threshold, which is currently 18,200 Australian dollars, or to claim particular tax offsets or tax rebates that are available to residents. On the other hand, they are not required to pay the Medicare levy. In terms of capital gains discount and obtaining the general 50% capital gains tax discount, up to the 8th of May 2012, the capital gains tax discount of 50% was available to foreign resident individuals who were subject to capital gains tax on taxable Australian property. For assets acquired after the 8th of May 2012, the discount is generally not available to foreign and temporary resident individuals. The discount is apportioned where a CGT event happens after the 8th of May 2012 and you acquired the asset before that date, or you had a period of Australian residency after that date. In terms of the main residence capital gains tax concession, from the 9th of May 2017, the government removed the entitlement to the capital gains tax main residence exemption for foreign residents that have dwellings that qualify as their main residence. Therefore, any such capital gain or loss arising upon disposal of a foreign resident's main residence will need to be recognised. However, existing properties held prior to this date will still be eligible for the main residence exemption until 30th of June 2019. Interestingly, the partial main residence exemption also no longer applies if, at the time a capital gains tax event occurs, the individual that owns it is a foreign resident. Capital gains tax withholding. Foreign residents' capital gains tax withholding applies to vendors disposing of certain taxable property under contracts entered into from the 1st of July 2016. The foreign resident capital gains tax withholding tax rate is 12.5%. It also now applies to real property disposals where the contract price is $750,000 or more. For contracts that are entered into from 1 July 2016 and before 1 July 2017, even if they are not due to settle until after 1 July 2017, the foreign residents' capital gains tax withholding tax rate is 10% and applies to real property disposals where the contract price is $2 million and above. Stamp duty. The 2016 New South Wales budget introduced a surcharge purchaser duty on the purchase of residential real estate by foreign persons. The surcharge is in addition to the stamp duty payable on the purchase of residential property. As a result of the 2017 budget, the stamp duty surcharge has been increased from 4% to 8% for agreements that were entered into on or after 1 July 2017. Further, a foreign person is no longer entitled to the 12-month deferral for the late payment of stamp duty for off-the-plan purchases of residential property. Land tax. A foreign person who owns residential land in New South Wales must pay a surcharge of 0.75% for the 2017 land tax year and 2% surcharge from the 2018 land tax year onwards. The surcharge is in addition to any land tax a foreign person may already pay. The surcharge may be payable even if a person does not pay land tax. The surcharge is assessed in relation to each parcel of land and is proportional to ownership. There are no joint assessments and secondary deductions do not apply. There is no tax-free threshold applicable to the surcharge. And finally, there is an annual charge on foreign owners of underutilised residential property. Foreign owners of residential property where the property is not occupied or generally available on the rental market for at least 183 days of each vacancy year will be subject to an annual levy starting at $5,500. If you'd like to know more about the tax implications of being a non-resident taxpayer in Australia, or you need specific advice in this regard, please contact us. You're welcome to email us at info@quinns.com.au. We'd love to get your feedback in relation to Quintessential TV, so please comment, like or subscribe. We look forward to seeing you next month. I'm Michael Quinn. Bye for now.